Welcome to TheoTrade. This is Don Kaufman. You're watching the Theo Weekend Update for April 21st, 2018. Well, let's get started with the idea of what comes around goes around, and that has to do a lot with rising interest rate fears. The reason I say what comes around goes around is, well, isn't that what kicked off the volatility in the equity markets all the way back in February? So, you know, we had some volatility that really kicked in early February, and most of that volatility was blamed directly for, well, rising interest rate fears. So throughout the month of February, okay, a little bit of March, some of those fears of rising interest rates kind of subsided and other fears tended to pick up. And here we've kind of come full circle. Now we're back again to interest rate fears. Let's be specific for just a moment. Let's talk a little bit about interest rates and the yield. First of all, the yield on the 10-year, okay, and that is the 10-year U.S. Treasury, those are the notes, okay, has now approached about 2.95%. Now, a lot of traders will actually tell you that the threshold that they really start to get worried about, it's not that you know, oh so huge number of 3%, but it's really about 2.8%. Is where everybody starts to get a bit nervous. The interest rate fears kind of resurface and the market kind of freaks out a little bit. We saw some sell side activity, but I'm going to tell you specifically where you're going to see some sell side activity here. So we're at about 2.95%. Really, this next week, we may see that threshold of 3%. And it's now been a considerable period of time since we've seen, okay, rates that high. Obviously, higher interest rates can impact, I mean, really everything in the economy. I could literally spend a half an hour talking about everything from credit card debt to student loan debt, okay, to the U.S. Treasury debt itself. All of them are expanding. But one of the things I think that will really impact you know, you're involved in markets on a day-to-day basis. One of the things on the surface that a lot of people don't think about are your dividend-paying stocks. And those are kind of like first to be served up on a platter to you if you're in heavy dividend-paying stocks. Let me explain what that kind of means. Look at an underlying that is paying in excess of about a 4% dividend, and you'll probably see, if it's a large market cap underlying, you'll probably see some fairly heavy sell side activity in just the last couple of days. Why? Okay, well, the idea is very, very simple. Why go out and start to purchase, if you will, an underlying that's paying 4% when you can go take some capital and stick it into, you know, a T-bill or a note or some type of treasury product that's going to yield, okay, next to 3%. And you assume that, you know, you're going to get your money back out of those treasuries in a few years. We also have the issue of short-term interest rates. Now, a lot of people, you know, on the news and so forth, they're going to talk about, like, again, the 10-year is 2.95%, but they're not looking necessarily at, like, you know, 13-week, you know, treasuries out there, which they're even approaching close to 2%. So, you know, 13 weeks, you're talking about like 2%, they're exploding. And this is what we're talking about with the yield curve kind of flattening out there. Now, again, dividend paying underlyings in excess of about 4% is that threshold. That's where a lot of portfolio managers are going to start to look and be like, well, why get 4%? We can go over here and get 3% and probably have a lot less risk. There's an interesting irony with that, is that the heavy dividend-paying underlyings, and again, I will pick on Verizon again for a moment, the heavy dividend-paying underlyings are thought to be low beta products, and they really are low beta. What does low beta mean? It means, okay, relative movement versus the S&P. You know, a lot of these, you know, dividend payers are supposed to be, well, less risky. The irony is, right now, they're more risky, and they have been, and they will continue to be in a rising interest rate environment. Now, let's switch gears for a moment. In a few minutes, I'll show you a little bit on the chart here what this rising rate environment has done to some of the dividend-paying underlyings. Okay. More importantly, let's look at the market as a whole. This past week, we saw markets actually channeling in a fairly tight range. The S&Ps, they rallied just over 50 points. They sold off. You know, we ended this week pretty much where we ended the previous week, with a bit of volatility in there. It looks like for right now, some of the buy-side activity has actually ceased. It looks like we're going into another patch of volatility, which is precisely what we're going to expect in a rising interest rate environment. All of it kind of ties back to the rising interest rate environment. You know, you're going to find out real quick that the marketplace in a rising interest rate environment is quite diabolical. Okay, and by that I simply mean, you know, you're going to see some wild sell side activity. You're like, I'm panicked for a couple of days, and then you're going to get 2 weeks where we kind of rally back up. Okay, things get a little bit more quiet out there. Listen, markets get tired, traders get tired, people are resting and so forth, and then they come in for another bout of volatility. And the reason I say that this is such a diabolical marketplace is for, you know, the last umpteen years, you see us buy the dip, buy the dip, buy the dip, and everything you do works. Okay, well, moving forward now, you got to have some skills, because we're not just going to have a marketplace that, you know, rallies per se to the upside. And it's frustrating because a lot of people are like, well, let's find the opportunity. Let's go out there. Let's buy the Amazon, you know, when it sells off over here. And you could be setting yourself up for disaster, because in a larger picture, we haven't really seen that much heavy sell side activity. I mean, you know, the Nasdaq, you know, finished the week still slightly higher. Nevertheless, we do appear to be right on the cusp of going back into a more volatile market. And again, moving this next week forward, you know, we're looking about a $46, $47 expected move in the S&P. Again, I'll show you that here in just a few minutes. Now, let's switch gears for just a moment. I want to talk a little bit about the financials. As I was saying, and we'll look at this again in a moment, as I was saying about the financials a bit earlier in the week, the financials happens to be kind of the object of my affection right now. In a rising interest rate environment, you would expect the financials, okay, to initially perform very, very well. So think about, again, everything that the financials have going for them, right? They get tax reform, they're getting deregulated. I mean, again, the world is pretty much at their feet in the financials, and yet they've stalled out in actually seeing some decent volatility, okay? And again, in a rising interest rate environment, you would think that the financials are going to do well. Well, this drum of rising rising interest rates, this drum beat is going to get louder and louder. And some traders, okay, are already discussing this. Well, in a rising interest rate environment, we're going to have higher bankruptcies, higher default rates, and that is going to impact the financials. And again, that's the drumbeat that's getting louder right now. And we're going to look for this. There's expanded volatility inside of the financials kind of moving forward. So let's get to it. Let's take a look at a few charts. We're going to, again, explore a couple of dividend pairs. We're going to look at the SPX and its expected move for this next week. We're also going to look at a couple of trade ideas. Thanks, everybody. Let's get to the charts.
Okay, so let's kick off our discussion here looking at some of the heavy dividend paying underlyings. What I have gone ahead and done is created a scan. Now, this is a scan specifically to the S&P 500. All I'm trying to do is just make a quick point. By looking inside of the S&P 500, which are typically our large market caps, I isolated to yield, which is the dividend, and we're looking north of about a 4% dividend yield, and then just simply hit scan, and there's 46 underlyings that are returned. Now, I've also set up columns here specifically for yield and beta. Okay, so let's take a quick glance at a number of these underlyings. So as I was saying, it's a lot of these dividend paying underlyings that are taking kind of the brunt of the hit in a rising interest rate environment. Let's look at a few of the items that came up in the scan. Now, we're looking at Verizon to begin with, and I've isolated this to a year-to-date percentage just to show you, again, some of the volatility that really sparked in the markets was right in this neighborhood here, if you guys don't remember February 5th, okay? However, there was already some sell-side activity that was hitting a number of the heavy dividend payers prior to that, and they've continued that slide. Again, just the last couple of trading sessions, you'll see volatility even picking up more. Verizon down about 10%. But I don't want to make this isolated to like one individual sector. So I started looking around a little bit. You know, we can make the same argument for something like Ford, which again, some pretty wild sell-side activity right in that again, rising interest rate kind of fears environment in early February, and now continues to see that. Again, this is prior to the earnings announcement. So maybe you're not thinking, all right, so we went from, you know, Verizon over to Ford. Okay, need we bring up something like Altria Group or, you know, the Philip Morris out there getting absolutely decimated right now? Now, again, some of this has to do with earnings inside of the sector. Nevertheless, again, you'll see that same kind of volatility surfacing out here back in the time of February. Last but not least on this front, let's actually cruise over to Qualcomm. all of these, again, all of these fairly heavy dividend payers. And the reason I wanted to bring up Qualcomm is because this thing, again, all right, there's some issues with Qualcomm. It really, though, has a lot to do with, again, look right back in this early February timeframe, specifically February 5th, where it's seeing some fairly substantial volatility, those fears resurfacing. It's something to really consider in the days to come because, you know, we're always going to be looking for opportunity here. You're probably questioning like, okay, so why are you showing me the heavy dividend payers taking a hit? Because I don't necessarily believe that interest rates are just going to continue to explode to the upside. And I'm already kind of looking for opportunity in some of these heavy dividend paying underlyings. You know, you have a marketplace where technology has just been exploding kind of day in and day out to the upside. We'll switch gears here for just a moment and cruise over to the Qs. Okay, so here's the Qs on a year-to-date basis. The Qs, ironically, are only up about 2% year-to-date, but there's a lot of tech underlyings that we've, you know, oh, they're exploding to the upside, and you almost get this like fear of missing out in a number of those key products. Nevertheless, real opportunities are going to start to surface. Okay, as markets see more volatility, real opportunities are going to surface, and trying to get ahead of that idea, I'm showing you, okay, areas that could be very beneficial, okay, to kind of understand in the near future. And that has to do with just a few of the underlyings we brought up, the Verizons, the Fords, the Qualcomms, maybe the Altria group. All right, moving on over here. So as we're discussing a little bit more about interest rates, there's one aspect I do want to cover, and that has to deal with HYG. Now, if you've never looked at HYG, I'm going to go ahead and broaden out the chart time frame. I'm even going to pull up on a 3-year daily. This is a 3-year daily. And this is a position that I am very much considering here in the near term. Well, what is it? Okay, first of all, the HYG, it's an ETF product. And the ETF product, it's for high yield. Okay, high yield. What is that? It's junk debt. Okay, so HYG, why do I select HYG? Because there's other ETFs like junk. It has to do with some of the liquidity that exists. Okay, this product did almost 18 million shares yesterday. The options themselves, okay, they're liquid. I mean, take a look at some of the strikes out here. Okay, unquestionably, when you get 30, 40,000 contracts trading per strike, there's enough liquidity to kind of get some of the job done. Interestingly enough, you'll look at some of the put open interest over here. It's almost awe-inspiring. That's 100,000 contracts. The position, though, that I'd be looking for inside of HYG, it's not necessarily what you think. Here's an underlying that if interest rates do really start to take off to the upside, what would probably be impacted the most is going to be your high yield. And if you look back at kind of the history of some of this, in HYG, this is an underlying that has had some really serious and wild bouts of volatility. Interestingly enough, take a look at the bout of volatility it had even earlier this year. Once again, there is that February 5th that's on the screen. Again, pretty wild slide to the downside. Nevertheless, I might be looking for something similar to occur in the very, very near term in HYG. I will discuss, again, how to structure this trade throughout the course of the week here on TheoTrade and TheoTrade chat. Okay, we'll have a broader discussion of HYG, but again, the position I'll be looking for would be to the short side. Again, this is not an underlying, however, that you can just go out and short. Why? Why can't you short the underlying? Well, this thing's actually paying almost a 5% yield, which means if you're short the shares, you're going to end up paying that 5% right out of your pocket. So we're going to get a little bit more innovative inside of HYG. And again, I will display that as this week kind of progresses. So let's go over to the broader market for just a moment. We're going to look specifically at the SPX kind of on this this weekend update here, and the SPX and all of the expected moves. Again, for those of you that are a little newer here, what we do is on a week-to-week basis, we look at the options chain and determine the expected move. So explain a little bit about that here momentarily. If we cruise over to the SPX, okay, first of all, the SPX did see some volatility as the week kind of progressed. It was down about $23. And it's also notable when you're looking at the SPX, you have options that expire on a Monday, a Wednesday, and a Friday. Now, we're interested right now in the Friday expiration because what this expiration is kind of depicting is, okay, movement. It's, hey, listen, this is the options market. okay, belief that the market's going to move about $46.71. All I do, okay, all I do is I take that $46 and change, and I plot that $46 higher, $46 lower. So what you like to do on a week-to-week basis is kind of keep a little bit of a running tally. Last week we were sitting right around a $48 expected move. This week, we're what, $46.70. I mean, come on, they're pretty much equivalents out there. Now, if you do look at last week's expected move, and it's really important to know that if last week's expected move is $48, that's $48 higher or lower. There is absolutely, okay, no bias into the expected move. The expected move, it's a fair and two-sided market. So throughout the course of last week, okay, we actually crested to the upside, saw some pretty heavy sell-side activity, okay, and again, ultimately, as I said, we started the week and ended the week pretty close. I think it was up about 0.4% on the week. Now, there's some interesting levels for this next week of trade. One of those you want to kind of keep in mind, and we've been talking extensively about levels. The week is going to begin right here at 2670. On the downside of the expected move, interestingly enough, this correlates right to 26, okay? 26 on the S&P futures. Now, 26 level on the S&P futures has held tremendous weight. That happens to be the downside. Now, for those of you also that remember, okay, earlier this week, I even talked about the possibility of not even testing 2676. I would actually be looking for a very near test of 25, again, 75. You want levels? I'm giving you levels. I would look for a test all the way down to 25.75. And you think about that, you're like, well, but Don, that's some fairly wild sell side activity. Again, here we are at 26.70. You're looking for almost a 100-point move to the downside, and the answer is absolutely. Okay, and one of the reasons that I'm actually talking about this, if you look back, we saw again the beginning of the year totally wild breaches of expected move. However, and I want to bring you this into a little bit more scope. If you look at trade, just kind of zooming in over here, look at trade the last, 1, 2, 3 weeks. Now we just had 3 weeks in a row that we closed inside of the expected move. So what's going on with the expected move is as we end up closing inside of the expected moves, the volatility starts to contract. All right, what does that mean? So the volatility contracts. It's making it, maybe less desirable to want to sell some options premium, but now that volatility is contracted all the way down again to about this $46 expected move, I think we can move handily outside of that expected move. Again, this is part of what I was just mentioning a few minutes ago, almost this like diabolical nature of the marketplace. I mean, markets, people, come on, they're really good at luring everybody in, especially back in, with the buy the dip. We see some, what you're looking at right now is a 30-day 1 hour. And we see some fairly heavy bouts of volatility, scaring people, 50, 100-point moves in the S&Ps in short periods of time, rip your face off rallies in here, some more sell side activity. But really all we're doing is just pinging back and forth, okay, between some levels. So we're back into, okay, our kind of level zone. And for those of you who are not aware, this is 26.82 to the upside. Right in the middle over here, okay, happens to be that 26, and down below, that's the 25.75 level. As I was saying a moment ago, we're back inside of these levels and kind of pinging back and forth. And this is where I would start to anticipate possibly a bid back up right to the, again, 26.82, and then some more sell side activity. A lot hinges upon this week of the interest rate fears. Now, I know what a lot of people are thinking. They're probably thinking, well, yeah, but there's some big earnings starting to come out. Okay, no doubt. I mean, Don, you didn't spend any time looking at Apple. Okay, it's pretty self-explanatory. The thing is down, what, 4%. No need to spend any more time on Apple. And I'll tell you why. It's because most of your major tech companies are going to go through earnings. And earnings, it's a binary event. It's a coin flip. So I don't feel it's appropriate. Like, why comment on, what's going to happen in Google? Oh, I know what's going to happen. They're going to pass through earnings this week. Okay. Oh, what's going to happen inside of Amazon? All right. They're going to pass through earnings. And yes, there is going to be an impact, okay, to the broader Nasdaq and the broader marketplace over here. But, okay, the overwhelming, okay, majority of that rhetoric is not going to be so much earnings, because I'll explain something interesting here in just a moment. It's going to be more about interest rates. And this is why, okay? We have earnings that have been coming out of the S&P 500, and the vast number, the overwhelming number of those earnings have been beating expectations. Yes, but as you beat expectations in the economy, oh, it's strong, it's good, okay, the tax reform is helping these corporations. Yeah, but again, then the drumbeat gets louder. What's the drumbeat that gets louder? They're going to have to raise interest rates faster than anticipated. And that's where, okay, we're going to see some selling in the bonds. So think about this, okay, how diabolical the marketplace really is. Better earnings could mean more sell-side activity in the bonds, okay, which is going to perpetuate fear to the broader marketplace this week. A lot to think about. Again, some trade opportunities that I will be bringing to all the TheoTrade members earlier this week. Stay tuned. Thanks everybody for joining us here at TheoTrade on the Weekend Update. Bye-bye.